Good day, fellow investors. I recently came across this Ark Invest Bad Ideas report talking about retail, banks, TV, railroad and transportation. As I'm looking into oil and natural gas now, so I'm very interested in transportation. I looked at the rail sector. I agree with Ark, extremely expensive, but the risks that I see and they are completely different. So we'll discuss that. TV, Seth Klarman, one of the best value investors out there, largest position. Retail, very interesting situation also for value investors, and banks are always there with Warren Buffett and everything. So I want to go through their thesis, discuss it, and you'll be surprised because I agree with a lot of what they say, but in different times and earnings and perspectives. So a lot of there to discuss. And we'll go through the full report they have done, discuss what's real, what's not real, but the main premise of the whole video will be what is investing. For me, investing is about risk and potential reward, and when you look at risk and reward, it's usually a function of price you pay. So again, one point that I am on the opposite side of Ark, it's always about the price, what you are paying for, and that's something that you learn through business, and you want reality and practical, predictable returns if you're a value investor, which is what I am and which is what this channel is all about. Let's dig into the report. So, Bad Ideas report, let's start. Physical branches, brick and mortar, linear, freight rail, traditional transportations, as we said. So, they are discussing banks, how their worst situation is that the offices, the brick offices, are really detrimental to banks, how 10% of the S&P 500 is finance and insurance, and things are going online, so this is very, very bad for banks. Okay, the numbers are clear. Venmo, Cash Card, and all other online cash apps have much more customers now than, for example, Wells Fargo. And their strategy is that offices are high on expenses and that 250 billion of those expenses will be detrimental for those banks. I'm looking at it from another perspective. So what is a bank? A bank, in this case Wells Fargo, is an entity that takes on deposits and gives out cards, mortgages, fees, etc., etc. And this is what Wells Fargo does. And no matter the digitalization, their deposits are not going down. Everything looks stable. So of course, ATM transactions are going down 16% and they will likely go down. However, they too are in mobile active customers, 24 million. So more than 50%, so that's also there. So these banks are not sleeping and they are selling those bank branches. So if I go back to Ark Invest and 250 billion of this value on a 3 trillion market capitalization of all the banks, if they all sell those offices in prime locations in your city, they can unlock 250 billion of value. So depends how you watch at those. Are they going to sell their prime real estate, go online, and they are slowly going there, but they are still balancing what's profitable, what's not. When it will not be profitable, the value will not be destroyed. The value will be sold and perhaps higher dividends and higher buybacks for shareholders. Just a different perspective. So we agree, yes, everything is going online, but not that fast. And there might be value for those banks when they lower their costs. Because what's banking? Banking is about managing capital and allocating capital, risk, reward, balancing. It's a big business and they know how to do it. Warren Buffett knows how to do it, and they will not be wiped out. I think both will coexist in this world. So yes, online will grow, but not destroy. That's a little bit too exuberant, too big a word to use. Alright, brick and mortar retail, I completely agree with, who is the author here, Tasha Kini here. So brick and mortar, very, very risky, because yes, the US has 10 times the retail square footage per capita than, for example, in Europe. So malls are not really trendy anymore. This is going down. E-commerce is accelerating. We all know that it will continue to accelerate. That's the world we are living in. So retail, very bad situation. Is it a bad investment? Well, let's check this. Is it a bad investment? I told you that investments are a function of price. Yes, here Macy's was a terrible investment. Also here. But I haven't analyzed Macy's, but just an example. Here, at a market capitalization of 2.35 billion, there might be retail opportunities out there. And the stock that I looked at recently, Restoration Hardware, I think it was February, exploded. So retail explosion, of course, they went online, e-commerce, omni-channeling and everything, but with retail, it's always about location, location, location. And I was told it was always about location, location, location. And when you compare that price to location, there might be great investments in retail for those who know how to look. The cap to treasury spread, so the yield you get on real estate with the yield you have to pay on the money, the interest, the spread is extremely large in this environment. So for those hunting retail opportunities, yes, bad stores, C REITs will go bust, but not everything, and you can't paint with the same brush the whole environment. So there will be good, there will be bad. That's certain. The trend is negative, but it doesn't mean that you will never go walk into a retail brick and mortar store. Linear TV, I didn't research this as a sector. More other sectors will come now to the sectors that I'm researching. So I don't know really in depth here what is what. Of course, I agree, all the old TV is about to be kicked in the ass, so that's something given. But again, when we come to prices, this is Seth Klarman's portfolio with all TV out there, also new internet. But when we look at the prices, okay, we are again low prices, so that for those who know how to price value, how to look for value, there might be opportunity. As I said, haven't researched a sector like TV, so I don't know things in detail. But I have researched railroad stocks, and then again I agree with Tasha here, who analyzed railroad stocks. I think, yes, I agree here. I have looked at all the railroad stocks. I think it was a month ago, 2 months ago. The free cash flow yield is 3%. Dividend yield is around 1%, which makes them extremely expensive. So very risky, but I don't consider them risky from the same perspective that Ark Investments see. Because what they see is that the exposure, the rail, has a big competitor. Electric and autonomous technologies increasing productivity. They expect that autonomous electric trucks reduce the cost of trucking from 12 cents to 3 cents, okay, and undercutting rail prices with the help of lower electricity and maintenance, as shown below. So trucks already offer faster and more convenient door-to-door service. Lower costs overall could be a significant blow to rails. Now, there is railroads. Have you ever had something like this delivered to your door-to-door? These are not door-to-doors designed to go door-to-door. So I think the analyst missed a little bit here what rails and freight is, and she should take her eyes off her iPhone and look at how big America is, how are things transported across America, not just, I don't know, probably New York. And then just raise your eyes, look at the fields, look at the grain, I don't know how it's put into a truck. It will not be an autonomous truck that goes alongside the grain harvester. So that's something. And then again, if you look at what these rails do, what do they transport? They are coal, renewables, grain and grain products, fertilizers. Then you have forest products, an autonomous truck backing into a lumber or something like that. I don't think so. Then when those tires explode, are they going to be changed autonomously? So it's not that easy. And then there is something else, something very interesting. So here they say that we believe that during the next 5 years, autonomous electric trucks will commercialize and take share from rail operators, a little competition there, a more cost-effective door-to-door service. If autonomous vehicles proliferate into various form factors, including flying drones and rolling sidewalk robots, we believe freight rail companies will have trouble competing with antiquated technology tied to dedicated infrastructure assets. Ark wonders which, if any, freight rail operators will survive. Rail companies have a lot of money, and if suddenly flying drones and rolling sidewalk robots are more economical to transport coal, to transport grain, to transport fertilizers to your door because you need 2 tons of potash for your garden, then they will invest in that. They have the money, they have the capital to do that, so they will buy the companies that have the technology and they'll combine that, and they might be even lower cost for keeping the high margin. This is just a risk. This is something that I miss in this Ark. Yes, this can happen, but I want, when research is done, when you make a white paper, you should also look, okay, why my thesis might be bad? And that's something very important for investing, especially bad investments. For example, I then went to a 2016 Ark presentation, and portfolio composition was 32% 3D printing, so that didn't work. Robotics, autonomous vehicles, okay, they were right there, but it's a very difficult investing environment, so we'll see how it works over the next 10 years. I prefer slow and steady, predictable cash flows that I know with a high degree of certainty that will be there. But this is robots, semi-trucks attacking freight. It's like 3D printing changing everything. That didn't happen. So might happen, but a lot of risks. So I'm just saying that should be emphasized that the risks are there too. So for me, railroads are extremely risky, but not from sidewalk robots, but because of the high valuations there. Just normalization in valuation and lower economic growth, what drives freight, might hit them 50%. So not Ark's idea. Maybe it's a smaller risk. It's always a risk to consider. That's why I'm also looking at this Ark report. But the biggest risk is valuation here, and future growth, competition, and less coal traffic, etc., etc. I'll put all the links of my research here, risk and reward, in the description of the video below. And now again, Tasha Keeney, analyst, traditional transportation. So they estimate that roughly 8 trillion of US public equity enterprise value in energy, autos, insurance, car rentals, and ride-hailing, the usual disruptor, will be now again disrupted by autonomous driving and robo-taxis and everything else that's coming. According to Ark estimates, US auto sales will fall nearly 50% from 17 million units today to just 10 million per year during the next 10 years. And again, this is highly possible, and that's why I also looked at it, because as I said, I'm looking at natural gas, oil, shale oil production, or risk and reward sectors that we'll discuss here. We'll discuss copper, which, if all this electrification happens, will do better. So again, video, I'll put everything in the research, all the research in the links report down. But there is again something that might not be as Ark suggests, which is again a risk, which is again a lack of this white paper. So I suggest when they rewrite this that they look at the risks. That's extremely important. Because, okay, flights, alternatives to 1 3-hour flights. I'm not going to half an hour I'm getting in flight to the Netherlands. I'm not going to sit in a car for 13 hours to get that for 1 to 3 hour flights. So again, take off the eyes from your iPhone and look outside how long it takes for these flights. So airports, the hustle of airport security lines, if we have automation, if we have everything, it will be even better. The car will bring you to the plane and then you'll fly. So also the impact, the technology can be used by others, like rail, like this, like that. So it's not that these people are stupid. So that's something, a risk that we have to implement in these theses. But I agree that less cars might be sold, and then also other disruptors, ride-hailing companies, those were never profitable. I don't know if they are profitable, so profitability is also key. Auto insurance rates could plummet because everybody is now driving autonomously, so that's again, okay, insurance, Buffett has insurance, but if there is less situations, less accidents, he has to pay less. So his float goes higher, and then of course the premiums disappear, but the value of the insurance business with Buffett is 20 billion on a $500 billion capitalization. When costs go down, no new premiums, doesn't matter. His float will remain there bigger forever as a profit. And that's something, again, that's normal insurance business. Reinsurance, who will reinsure all that? Who will have that? So it's not just that easy. It's not just reinsurance. So new Tesla insurance, okay, reinsured by General Re or something like that. So it's a big business, and this is a superficial overview from my point, but very, very interesting, because here I really agree. If we look at car dealership, okay, they will be disrupted, and oil industry with all the electrification going there, but they are expecting that EA expects EV penetration of 2% by 2022, for example. Ark would not be surprised to see 20%. I'm going to send myself an email December 2022 or March 2023 that 20% will definitely not be there, because there are the supply chain to deliver, again, a reality check, the supply chain to deliver 20%, which is 17 million cars sold per year. 20% is 3.5 million cars, electric vehicles sold. That's what, 7 Teslas. To ramp something like that up, to find the lithium, nickel, batteries, everything, to create a supply chain, and then to deliver to the customer takes at least 10 years. So it's not just about what you want, it's also about the possibilities of the supply chain. Yes, it's growing fast, but not to 20%. I'm saying EIA 2%, let's say I say 4%, I'm going to send myself an email in 2 years down the road, and we'll see who's right, Ark, me, or EIA. 4%, Ark says 20%. Of course, robo taxis, the supply is what they are missing, the infrastructure around that. It takes a lot of time to develop everything, and this is again a risk that they are missing. Oil demand forecast, this is what drove me here. So they see stable oil demand, and then they see declining total global oil demand. 40% of oil demand, 50% is transport. So they see already in 2030 no more oil demand for transport. That's also a little bit too much, because that means that no car in 2030 is with an internal combustion engine. So also that planes grow and grow electrically. So it's a little bit too much, too risky. So should be, perhaps this one is right, and I'm looking into this, the middle exemption. the middle expectation to see how it will affect oil prices long term, whether there is an investing opportunities, because again, prices are low now, which means that the risk is lower. At some point, the risk is very limited, depending on what you're looking. Shale report, shale oil, risky, so it's coming out. Other less risky, so that's all what we do on this channel. And risk and reward, so subscribe if you haven't. All in all, Ark disruption, but it's still just a non-disruptive, old-style, old-fashioned Wall Street business. Let me show you. So you try a lot of things. When something works, you have, what is this, 1, 2, 3, 4, 5, 6, 7 ETFs. Some of these will explode, some will not. Those that do really well, do you a lot of, well, marketing, then you charge 0.75. Vanguard is really disruptional with 0.04. This is 0.75. They make their 70 million per year on the 10 billion they have. It's a good business, typical Wall Street, well diversified portfolio of 35 holdings, 50 holdings, so there will be some great winners there. And actually, Ark Invest, for being the investor in disruption, is pretty standard. And unfortunately, they should hire better researchers because we don't know about the future. I wish I would. They missed on 3D. A lot of people missed on 3D. What will be the future? Only the future will tell. So I'm pretty sure that in 10 years this world will look much differently than it looks now. Like 10 years ago it was different than it is now. 20 years ago we didn't even have broadband, etc., etc. But some things will remain, some things will go, and I'm looking for more certainty, less risk, perhaps less reward than Ark Invest definitely over the last year. But okay, that's me, that's what I do, and slow and steady over the long term without taking excessive risks and with doing hopefully better research. Thank you for watching. Let me know what you think in the comments. What is the risk reward? Please put a risk reward perspective in it, not just that exuberant cheering of stocks, because that's not what we do on this value investment channel. Thank you, and I'll see you in the next video.